Now that we know the difference between product and period costing, let's have a look at an example. This is based on an old exam question. So let's say a business purchased stock on the 1st of Jan and had the following bits of information. We've got the supplier's price, which is 100 units, they're $7 each. That was on invoice 345. Got cartage inwards, which was $100, but that covered 100 units. That's on check 89. Got some customs duty, which is $200 per annum, paid on check 90. And lastly, we've got some depreciation of a delivery van, which is $500 per annum, and that's been recorded in memo 2. So one thing to note is that each of these has actually occurred on a separate document. We're going to need that information in a second. So what we're going to try and do is classify each of these expenses as either cost of goods sold, so costs required to get stock in a condition and location ready for sale, and we either can allocate them, which will make them product costs, or we can't allocate them to each unit, which will make them period costs. We'll also still have other expenses, so the costs required in running the business. Let's take the first one, supplier's price, $7 per unit. Is it required to get stock in a condition and location ready for sale? Yes, it is. Can it be allocated to each individual unit? And again, the key word here is logically. So is it logical? It is. It's $7 per unit. So if they're both yeses, that's going to be a product cost. We've got the cartage inwards for $100. Is it required to get stock in a condition and location ready for sale? Yes, it is. Can it be allocated to each individual unit? Well, it hasn't been. We've just got $100. However, that does cover, it says here, 100 units. So it's $100 for 100 units. It's pretty logical to allocate that at $1 per unit. So what we'll say is we can allocate that one, and we've got another product cost. Let's look at the customs duty, $200 per annum. Is customs required to get stock in a condition and location ready for sale? It is. Can it be logically allocated? In this case, we can't, because it says $200 per year. I mean, how many do we sell a year? We don't know. Is this the only product we sell? We don't know. So because there's no real logical way to allocate this, we're going to have to leave it out. If we can't allocate it, but it is required to get stock ready for sale, that's going to have to be a period cost. Lastly, we've got a delivery van that we make deliveries to customers. So is that required to get stock in a condition and location ready for sale? We're going to argue that that's no. That's sort of more of a cost incurred in running the business on a daily basis. We don't need it to sell the stock. It just helps us, once we've sold it, deliver it to customers. So we're going to say that the first condition there is no. That's not required to get stock in a condition and location ready for sale. So can it be allocated to each individual unit? In this basis, it says $500 per year. We're going to say no. So if they're both no, that becomes an other expense. So looking at what we just did, we're going to allocate each of these expenses to one of the three pots. So we've got the cost of goods sold over here, which is made up of product costs and period costs. And we've got the other expenses here. So first of all, we said the supplier's price was a product cost. Cartage inwards was a product cost at $1 per unit. Customs duty was a period cost, and that left the delivery van as another expense. So in the long run, we've ended up with product costs as a total of $8 per unit. And let's assume now, how would we record this in the stock card? So I've basically got $8 units, and I've got 100 of them. What would that look like? So I could first of all record invoice 345, 100 units at $7, which is 700. Why is it only 7? The reason is I'm going to record the supplier's price on its own like that, invoice 345. However, what also attached itself was the cartage inwards. So that covers the supplier's price. But now I'm going to put in the check 89 here, which was 100 at 1 for 100. That represents this here. So that kind of looks like I've got a quantity of 200. I actually don't. What I'm saying is that's the same bit of stock. It's just come in two parts. And together over here in the balance column, that's going to be 108 for $800. So you can record it like that. I wouldn't recommend it though. I think that's very confusing. To look at that, it does look like 200 have come in, which doesn't make sense. So what we should do is let's record it this way. In the date, keep it the same. In our reference, we'll make one change. What we'll do is we'll record both documents together like that, as opposed to here, where it was done separately. And what we'll do instead is instead of recording these costs separately, we'll just put them together in one batch like so. And then that'll give us the same balance overall, just with both of them together, which is 100 units at $8. So either approach is okay. I recommend we use the second one because it reads a little bit easier than the one that's above it. Let's look at our income statement. So we've got product cost of $8 per unit. We've got a period cost, which was customs duty of $200. Together, they're the cost of goods sold. We've got depreciation of $500, and let's say we sell 100 units at $16 each. That's a total of $1,600. Let's do less our cost of goods sold. So we'll start off with our cost of sales. Now remember from our previous video, when we say cost of sales now, we mean product cost. Okay. So if we sold 100 units, that's 100 times 8, which is $800. We've also got some customs duty, which we couldn't allocate. That's $200. And together, that's a total cost of goods sold of $1,000, which will give us a gross profit of $600. That's less away our other expenses, which in this case we've got depreciation of $500, and that'll give us a net profit of $100.